In this real estate exam prep preview, we're going to talk real estate financing. In this edition, discount points, equity, and what exactly does it mean to be underwater on your mortgage. The first thing that you'll need to understand about real estate finance language, specifically here with discount points, is to understand really the financing jargon of discounting. And what discounting means in financial terms essentially is paying something in advance. And really here when we're talking about financing, it's paying interest in advance. So a discount point by definition is 1% of the loan amount. And therefore every point that a borrower is charged would be 1% of the loan amount, which is discounting that interest balance on the loan. Therefore, it increases the yield or the rate of return on the loan to the lender. The yield or the rate of return is really the profitability of the loan to the lender. And so the advantage of discount points to the lender is that's interest paid in advance, usually at the closing table. However, what it also means for the borrower is that the cost of closing that loan is going to be a little bit higher. So when it comes to discount points, you want to understand that essentially for every 8 discount points that a borrower would pay, it would increase the yield to the lender by 1%. So what you want to remember for the test is that discount points are purely interest and do not pay down the principal balance at all. So when we're looking at discounting, you want to think interest and you want to think paying interest in advance. In order for a lender to factor the amount of points that a borrower is going to have to pay, they're typically going to look at 2 main factors in consideration of the borrower's qualification and other financial instruments. First, they're going to look at the difference in the loan's interest rate and the yield that the lender requires. And second, they're going to look at the length of the time that the lender expects until the borrower is going to pay off the loan. So in other words, what's the interest rate relative to how much the lender generally requires as their rate of return on an amount of money that they lend? And number 2, how long does the lender expect the borrower to actually hold and make payments on the loan? That's going to affect the profitability. And so those 2 items are what are going to be factored in when the lender is going to consider how many points to charge. But generally, by charging discount points, the lender can also offer the borrower a lower rate, since the borrower is paying their interest in advance, really at the closing table, the discount points. Well, this allows the lender possibly, since they're taking in interest money up front, to lower the interest rate over the life of the loan. Remember, discount points are part of the loan transaction, so typically they're going to be paid by the borrower. However, during negotiation, it is possible to agree, for instance, on a purchase agreement that the seller may help the borrower pay discount points. That's all part of the negotiation of a real estate transaction. So now let's look at the hard math of how discount points would be calculated. So in this real estate skill, we want to remember that for every 1 discount point, that equals 1% of the loan amount. And remember, when we're dealing with real estate finance, the loan is always based on the sales price or the appraised value, whichever number is lower. So in this example, the sales price of a property is $88,000. The appraised value comes out to $90,000. If a lender is charging 3 discount points on an LTV of 90%, how much are those discount points? So let's take a look at how this would be calculated. But if you want, it's a good idea to pause the presentation right now and try it for yourself before we show you the solution. Okay, hopefully you were able to try to work this out on your own, but let's go ahead and show you step by step. So the solution looks like this. Number 1, we have to understand the amount of the loan in order to be able to calculate the discount points. So remember, the amount of the loan is going to be the sales price or the appraised value, whichever number is lower. And since there's an LTV here of 90%, that means that the lender is going to lend the borrower 90% of what they need in order to close this transaction. So 90% of the lower of those two numbers is 88,000. So 90% of 88,000 comes out to 79,200. That's the amount of the loan. Therefore, if they're charging 3 discount points, it's simply 3% of the loan amount, or 3% of 79,200, which comes out to $2,376. So the key points to remember here that I'd like you to know for the test. Number one, remember, they're always going to consider, in factoring the loan amount, of the lower of the appraised value or the sales price. That's number one. So since 88,000 is the lower of those two, that's the number that's going to be used here, right? The second is to understand LTV. Remember, LTV is the loan to value ratio, or how much the lender's going to lend. The other 10% would be the down payment by the borrower. So since the LTV is 90%, that means 90% of 88,000 is going to be the loan amount. So that's some simple real estate financing calculation for you, and it's something that you'll want to make sure that you know and practice before you take your real estate license exam. The next concept we want to talk about in this prep video is that of equity. Equity is a common term in the real estate marketplace, and the simple definition of equity is the current fair market value of a property minus what is owed. So in other words, it's the current market value minus whatever is owed, such as the mortgage. Therefore, it's considered the owner's stake in the property. In other words, how much the owner could reasonably expect to take home after sales and sales expenses. It's their ownership stake. So therefore, sometimes equity can be borrowed against for future debts, such as a home equity loan or a home equity line of credit. But essentially, what you want to remember for the test is that equity is the current fair market value minus what is owed, not the value at the time the debts were taken out. That's important to remember. So let's take a look at how you're going to calculate equity. When it comes to equity, remember, the actual formula is the fair market value minus the debts. So in this example property, a property originally listed for $175,000 and sold for $170,000. If its current value is $225,000, the original loan amount was $161,500, and the owner's current outstanding balance is $156,322. A second mortgage had just been obtained for $15,000 to help put a child through college. The owners also owe an unsecured credit card debt of $2,200. So what's the equity in this property? And it's a good idea, as usual, to pause the presentation and try to calculate this yourself. As you'll see, as a special hint, there's a few numbers thrown in here that you can go ahead and ignore. Can you figure out which ones they are? Okay, good. Hopefully you had a chance to try to work out this problem yourself. Now let's show you the solution. So since equity is simply the current fair market value minus what is owed, the solution looks like this. Since the current value is $225,000, we're going to subtract the balance of the original loan, which is $156,322. So that leaves you with $68,678. But then remember, we had that second mortgage of $15,000, which is a mortgage or a lien directly on the property, which also needs to be removed from the owner's equity. So that results in $53,678, which is the seller's current equity. So note that things like the listed price or the sold price or that unsecured credit card debt are not considered in the calculation of equity. So if you left those out when you worked it out, you did great. Good job. The final concept we want to talk about here is the practice or the concept of being underwater on your mortgage. Essentially, being underwater on your mortgage means that you owe more than you actually have in equity or the current market value of your property. So what it means is, even if you sold your property for current fair market value today, you wouldn't even make enough money to pay off your loan. You're completely underwater. So this is a bad situation for a homeowner to be in, which generally is why you want to keep an equity buffer and not continually borrow up to the current value of your property, because if it were to go down, you may find yourself underwater.